Hi, everybody. Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania, and it's the first of the month update. What am I going to talk about for March? I'm going to talk about the Ides of March. Now, if you're a history buff like I am, you might realize that Julius Caesar was on his way to the Roman Senate when he had a seer, or commonly called a fortune teller, say, Julius, you should not go to the Roman Senate today. Something bad's going to happen. And that's why they call it the Ides of March, because typically what we've seen, even in the financial world, is sometimes bad things happen in the month of March. So why am I talking about the Ides of March right now? I am talking about it because the S&P 500 made a new high in February and is now up 4 months in a row from October. This has been fueled massively by the investment in AI that we've seen out there, with a lot of these stocks really getting ahead of themselves. And I want to point this out. People have got to stop chasing these artificial intelligence stocks. Now, I'm going to use an example at like NVIDIA. It's not a recommendation to buy or sell, but just to give you an example, if you were an engine manufacturer and you produced 100,000 engines, and then you said to the car manufacturers out there, hey, I want to sell you 100,000 engines, and the car manufacturers are like, hey, we're only going to sell 10,000 cars. We don't need an extra 90,000 engines. What do you think would happen? Well, that's kind of what's happening with the whole chip scene as far as artificial intelligence goes, is a lot of these chips have been sold and they're sitting in inventory at the companies that are making products, and they're not really being used yet. So when you have a situation where, like NVIDIA, and again, not a recommendation to buy or sell, is now worth more than the entire Chinese stock market, there might be some valuation problems there. Now, again, we're not saying that the market's going to have a precipitous fall from here, but it would not be unusual to see some kind of consolidation or pullback from the 4-month rally that we've just had. So let's talk about interest rates. Interest rates are at a crossroads. If you remember last year, the story was that the Federal Reserve was cranking up short-term interest rates to try to stall inflation out. And we saw the 10-year Treasury hit a high of 5% at the end of the year last year, and then fall rapidly. Well, now the 10-year Treasury is right around 4.25%, and it's kind of at an important juncture at this point in time. Now, our longer-term view is that we think interest rates are in a trading range for much of 2024. But depending upon how some economic numbers and inflation numbers come out in the next 2 to 3 months, you could see interest rates fall back below 4%, or you can see them float back up to 4.25%. So one of the things that we're doing is that anytime the 10-year Treasury gets to be around 4.25%, we are lengthening duration or buying longer-term bonds. As of this video, you can still get a 3-month Treasury at 5.38%, which we think is a good deal, but we're suggesting that we move a little bit farther out the yield curve, again, in case short-term rates come down. Now, we're not in the camp that the Fed is going to lower short-term interest rates dramatically this year. We think that idea has actually been on hold, but we could see a 0.5 to 0.75% lower in short-term interest rates. But again, the bond market, especially the 10-year, is kind of at a crossroads right now, and we think yields float a little bit lower, but if they do back up, it's a buying opportunity. But again, one of the things that the interest rate investors are looking at is they're looking at inflation. And this is a chart of crude oil. Now, 2 years ago, we were a big bear on crude, and we thought crude oil at the time was almost $100 a barrel, and that it could literally end up going down to the low 70s, which it ended up doing. And you can see that in December, crude oil got down below $70 a barrel. But look at this chart, and you can see that from the highs of October of last year, crude oil continues to break out and grind higher. So if crude oil breaks over $80 a barrel, it could have a quick move to $90 a barrel. And again, why do we watch crude oil for inflation numbers? Because just about everything that you eat, touch, or use is made out of some kind of petroleum product. And what ends up happening is as crude oil prices go higher, those things, the costs from a manufacturer standpoint, go higher as well. So here's gasoline at the wholesale level. And this also shows the same kind of chart. After bottoming out back at the end of the year, you can see that gasoline is literally up almost 50 cents a gallon on the wholesale level. But again, there's a breakout going here. And guess what? This just happens to coincide with when people start driving the most is in the spring and summer for vacation. So these are important inputs into inflation. And so the reason why we think the Fed is going to be very, very slow to lower short-term interest rates is that some of the components or inputs into the inflation number are actually coming back around. And this is one of the Fed's biggest fears, is that if they lower interest rates too soon, inflation reignites and they got to raise interest rates again. So just to sum it up, as of February 2024, the S&P 500 and other major indices are up 4 months in a row. A consolidation or a pullback would be normal at this point in time. We have literally now gone 5 months without a 10% pullback. So to see a 3 to 5% pullback would not be out of the norm. But future inflation looks to be increasing. And we think that keeps short-term interest rates higher for longer. Overall, our risk indicators are still elevated, especially our valuation of stocks. So right now, the S&P, from a price earnings standpoint, is trading almost in the 95 percentile as far as valuation goes. Now, again, that we don't use that as a timing model, because overbought or overvalued markets can stay overvalued for much longer than what people think. The same thing on the inverse. So when a stock market goes down and it becomes undervalued, it can be undervalued for a much longer period of time. But again, we are still cautious at this point in time. We're picking our spots. We're trimming extended positions that we have in equities, and we're watching to see what's going to happen with some of these inflation numbers and interest rates in the next couple of months. So that's it for the first of the month update for March. We'll be back next month. We'll talk to you soon.